We're going to the second part of economic environment indicators, and in the last webinar we were basically referring to the monetary policy. Now, monetary policy consists of 4 or 5 commonly used tools. Now, one of course is the interest rate, the other one is our open market operations, cash reserve ratio, and something called statutory liquidity ratio. There is also another one which is called moral suasion, which we'll discuss a little while later. Now, open market operations are basically a technique whereby the RBI sells government securities to the commercial banks. So, when the commercial banks buy those government securities, to that extent, the money is sucked out of the system. Similarly, if the RBI starts buying government securities, in that way the money is sucked into the system. By raising the CRR, now what happens is that a certain portion of the net deposit and time liabilities is kept in terms of cash. So it is kept like a reserve. So the credit ability to grant credit gets reduced to that extent. The statutory liquidity ratio is another way of ensuring that the banks are solvent. What they are required, and again, as 25% of the net deposit and time liabilities, they are required to invest in government and approved securities. Now, because they are required to invest in government and approved securities, now to that extent, those securities are safe and which can be liquidated at any point of time. So that ensures that the not only is the bank solvent, but at the same time, the credit granting ability of the banks is again constrained. There is also something called moral suasion, whereby moral suasion is from time to time the RBI basically gives an indication or advises the banks regarding some of the particular areas which they should grant credit or they should not grant credit, or whether they may advise that you may require certain higher margins on certain type of loans and advances, which if implemented across all banks gives a certain amount of leverage in terms of where the credit is going to. So, for example, if you're looking at open market operations in Sierra, the impact is widespread. Whereas if you look at in terms of margin requirements, so we are referring to basically inflation in, let's say, selected sectors. For example, if you increase the margin on in terms of agriculture goods and commodities, so the inflation in the agricultural sector is constrained. The other way is in terms of increasing the interest rates. Now, the RBI basically has 2 ways by which it can increase interest rates. One, of course, is, as I said, which is earlier mentioned, is the CRR. The other 2 are the repo rate as well as the bank rate. Now, by raising the repo rate and the bank rate, it sets the floor by which the other banks are forced to reduce or increase their interest rates. The other alternative, of course, is by when in terms of banks increase the risk weightage of certain of the loan portfolios. So depending on the risk weight that the RBI forces them to put on certain loans and advances, to that extent, if that particular sector becomes more risky, so that the commercial banks need to increase their interest rates on that particular loans and advances in those sectors. Now, when we talk about interest rates, now essentially interest rates, we can understand them in 2 ways. One is the nominal rate of interest that we are normally used to, and the second is the real rate of interest. Now, for example, the rate of my savings bank deposit on my savings account is, let's say, 3.5%. Now, that is the nominal rate of interest. That is the actual rate at which I am going to get interest on the sum of money that is going to be kept in the bank. But does it really account for in terms of the actual purchasing power of money? It does not. So for that, if you subtract the inflation rate from the nominal rate of interest, you will get something like the real rate of interest. That actually measures the actual purchasing power of money. So if one needs to take economic decisions, rather than just take the nominal rate of interest, one needs to take the real rate of interest. Now, in an economy, to control inflation, you need all these factors in terms of both monetary policy and fiscal policy. There are 2 states which are equally dangerous. One is inflation and the other is deflation. There is a third one which is something which is combining of inflation and deflation, which is called a stagflation. Now, stagflation is basically the economy is stagnant, but at the same time one is suffering from inflation. This is approximately the current state of where India is at the current level, where we are experiencing some signs of stagflation, wherein we have inflation, but at the same time the economy is slowing down. inflation, a certain amount of inflation is said to be good for the economy because it raises prices more than the cost, and it gives an incentive for the producer to produce more because the profits are more than the cost. But however, it hurts the consumers more. As far as the government is concerned, it is a hidden tax. So to that extent, they also get more revenues because obviously the DNS allowances are not adjusted in the same rate as inflation. So to that extent, that even if the price increase has been there, but because they are taxed at the same rates, so essentially their income gets reduced, right? And the government gets its tax revenues, and to that extent the purchasing power gets curtailed to that extent. Now deflation is more dangerous than inflation because inflation, a certain degree of inflation is perhaps good for the economy. Of course, if it's runaway inflation or two-digit inflation, then it is some cost of money. But deflation again is more dangerous because that represents a state of the economy where the national income, employment, everything goes down. Now, basically, the reason why deflation can occur is basically the supply of goods and services is more than the supply of money. That is essentially the reason why deflation happens, or the demand of money goes up, or the demand for goods also come down simply because there are some leakages in the income stream. And deflation, there are in terms of inflation and deflation, there are something called business cycles. So in terms of inflation and deflation, now there is a fallout of the inflation and deflation, which is basically measured in terms of business cycles. Now business cycles are areas of contraction or expansion of economy, and there are typically 4 states of the expansion or contraction, which is one is expansion, and then one is peak, then the third is recession, and finally is a trough, which is basically called depression, right? And the measure of recession is that if, let's say, 2 quarters the national income goes down to that extent, and one can say that you are in recession, right? Now both inflation can be used as a way by which you can kickstart the economy, in the sense that when the government pumps in more money, then to some extent one can avoid going into a recession. Now the other one is of course reduction of interest rates. Now a sign of depression or recession can also be looked at in terms of the yield curves. Now when you look at yield curves, there are already 4 types of yield curves. One is rising yield curve, one is downward sloping yield curve, one is a flat yield curve, and the other one is a humped yield curve. Now a normal yield curve is something which is supposed to be rising, which means that longer duration securities should carry more yield than the shorter duration securities. A flat yield curve is something which means that across the spectrum, the yield curves are across the same, whether it is for a shorter duration security or for a longer duration. That means a 1-year security would carry the same interest rate as, let's say, a 10-year or a 15-year security. That would be the position in case of a flat yield curve. The other category is a downward sloping yield curve, wherein in that case the longer maturity yield curves securities actually carry lower interest rate. Now that is a short sign of recession, because it shows that there is very little confidence with regard to longer duration securities, and people would rather invest in shorter duration or immediate securities because there is a whole lot of uncertainty in the system. In between there is a humped curve. Now the humped basically means that over between the shorter period and the long period, there is a medium term which may be either downward or upward sloping, which means that either they may be more than the shorter duration or lower than the shorter duration. So in that case, it creates a kind of a hump, right? Now, when we are looking at the economy, right, in terms of what are the possible ways by which the government can control the economy. One is the fiscal policy, second is the monetary policy, third is the wage policy, and the last is the is the export policy. These are some ways by which the government can actually influence the economy. Now, when I say fiscal policy, we are basically looking at rates of taxation, and rates of taxation which refer to both direct and indirect taxation. Indirect taxation covers both excise duty and custom duty. Direct taxation covers income tax as well as corporate tax or wealth tax. That is a direct impact. Now, in terms of that is in terms of fiscal, and then it also covers in terms of government expenditure. Which directions would the government would like to make its expenditure? Is it on infrastructure? Is it on subsidies? Is it on certain employment guarantee schemes? So that is the expenditure part. Monetary policy is in terms of how to control the money supply in the economy. Wage policy is in terms of, for example, how it would fund its pension requirements. What are the kind of salaries that it would like to give to its employees? So, for example, the 6th pay commission is just coming, and the estimated impact of GDP is something like 0.4% of the GDP, and one is estimating that 15 to 20% of the wage bill of the government is likely to increase. And the last is basically in terms of the export policy. Now, if you look at the export policy, we are basically talking about the balance of payments. The balance of payments refers to both on terms of current account and capital account. Current account basically refers to export and imports of both goods and services, as well as import-export of goods and, as well as services. Right? There is one on the trade account, which is a merchandise account, and there is one on the services account. The capital account basically refers to the portfolio money, which is basically foreign direct investment, or which is basically money which is goes into shares and securities in terms of the investment in the Indian stock markets or in Indian securities. That policy in terms of how the government would like to manage its export policies, and in terms of giving subsidies to the exporters, and in terms of how it manages its exchange rate, has a substantial effect in terms of how the import expenditure gap is going to be financed. This is in terms of the basic facets in which how the government would like to influence the economy. Now, there are some other economic indicators which one needs to understand in terms of how well the economy is functioning. For example, you may have in terms of GDP, that is gross domestic product, that is consumption plus investment plus government expenditure. Then there is national income, which is basically includes the export surplus, that is a net income from abroad. Then there is in terms of one is gross, one is net. Gross is in terms of which does not remove the depreciation, whereas net basically removes the depreciation. So these are some indicators in terms of how the economy is doing. Then there is a per capita income, which looks at in terms of the population, what is the net income per individual. Apart from that, there would be some estimates in terms of subsectors, which is primary, secondary, tertiary, in terms of certain industrial sectors, in terms of small scale industries, large scale industries, growth rates. That would be another indicator in terms of how well the economy is doing. Right? Then there are some indicators with regard to, let's say, the stock market. Now, the stock market is a very good signal in terms of how the economy is expected to do well, because the stock market gives a listing of all the stocks and shares in the economy, and so